Assalamu alaikum, hello and welcome to Gurukul Online Learning Network. Today your instructor Sheikh Mahadi. We're going to study finance and banking. Chapter 6, long-term financing. So our today's topic would be disadvantages of common stock, difference between preferred and common stock, and lastly difference between share and bond. Before differentiating share and bond, we will learn about the concept of what is share and what is bond. So in the previous lesson, we learned about what are the advantages of common stock. So let's now talk about the disadvantages of common stock. First disadvantage would be last to get paid, high potential cost, no reducing tax burdens, earning dilution, then high flotation cost, ownership change. These are the few disadvantages of common stock. So let's discuss them. Last to get paid. An important disadvantage of common stock is if the company is liquidated and an investor might not receive anything. This is because common stockholders are the last in the pecking order. Bondholders and other debt holders, preferred shareholders must be paid what they owed before the money is distributed to common stockholders. As I said, everything, if something has good, it also has bad. It's equal ratio. It's an equal ratio of 1:1. So the common stockholders get paid at the very last because the normal bondholders, the mortgage holders or the preferred stockholders are promised a certain amount of money that will be given at the end of their business period or business time. That's why after giving all of them money, firstly it goes from the director level, the main owners, then comes the preferred stockholders, debenture holders or the bond holders, and then after there comes the normal or the general or the common stockholders. They get at the last of the pecking order they are. After giving everyone money, sometimes their proportion is very low, sometimes they get an adequate amount of money. So owed before the money would be distributed to common stockholders. If there is nothing left on the common stockholders, they might come on empty-handed. So as I said, if this amount of money is being divided like this, sometimes it grows like this big to this small, sometimes it just vanishes within a blink of an eye. And that's how sometimes common stockholders do not get anything at all if the company is in high profit. Secondly, high potential cost. Common stock have a burden of offering a high earning potential compared to the bond certificate deposit or the stockholders might be offered in a higher rate of return. These other investments are guaranteed. So you know the maximum and the minimum amount that you stand to gain from them. However, common stocks have no limit. While that means you may lose money, it means there is no limit to how much you can gain. The portion of there is, while you may lose money, no certainty of how much you may lose money, and there is no certainty of how much money will you gain. No, there is a certain limitation of money losing. Like the much you invested is the much that you will lose at a time. But in case of money gaining, there is absolutely no limitation or no limit. Then no one knows how much will you get. If you invest 5 lakhs, sometimes you can get 10 lakh, 15 lakhs, 6 lakhs, 7 lakh, 8 lakh. It depends on the company. High potential cost, that is. Not reducing the tax burden. Dividends are not tax deductible like other debt instruments. The payments of common stockholder is made after giving taxes. The preferred stockholders get the dividend or the share before paying the company's taxes, but the common stockholders get it after paying the company's taxes. High flotation cost. The insurance, i.e. underwriting, brokerage fees and the other issues expenses is higher compared to the other securities. It only happens in case of common stockholders. Common stockholders are basically the owners of the company, small owners, but within that small owners, they have to fill out all the gaps they have in the company. They will participate in everything. That's why sometimes they get too much money and sometimes they do not get money at all. Ownership change. The issuance of new stock may change the ownership of existing stockholders by unbalancing the previous proportion holding by the management. That means ownership change. First of all, it's a liquid money. Stocks are liquid money basically. You can just change your ownership in a blink of an eye within some documentation, legal documentation and paper within the companies. Then earning dilution. The issue of new stock dilute is existing stockholders earning and decreasing the proportion to increase in the number of share. That means earning decrease in proportion to increase of number of share. Suppose someone bought 500 share but they are getting their earning according to 450 or 460 share. That's why they said earning is decreasing to the proportion of existing shares. So let's talk about preferred stock. Difference between preferred stock and common stock. We knew about common stock earlier. Let's talk about preferred stock. A class of ownership in a corporation that a higher claim of an asset earning common stock. Preferred stock generally is divided must be paid before the dividend to the common stockholders and those shares usually do not have any kinds of voting rights. It's a typical financial instrument that exists characteristics of both fixed dividend and potential appreciation. It is known as preferred share. Preferred shareholders, or those preferred stockholders, may have priority over the common stockholders. They are next to the common stockholders. That means they are in the middle, after the owner and before the common stockholders, in the asset of liquidation, and have a fixed dividend paid before the common stockholders. It will always be paid before the stockholders, because in the pecking order, the common stockholders are at the most below stage. They hit rock bottom. But if they give up their voting rights, it's less potential for the appreciation. Like, a preferred stockholder has to be paid a promised amount of money at the end of each business period. Those are called the preferred stockholders. So let's talk about the difference between preferred and the common stockholders. Let's talk about the preferred as we speak of. Preferred stockholders have a greater claim to the company's assets and earnings other than the common stockholders. This is a truth during the good times, and when the company has excess cash and decides to distribute the money in form of dividend to its investor. That's how the preferred stockholders get more, because one is promised, and if the company is making profit, you have to give a proportion of that profit to the investors also, the preferred stockholders. In these instances, when distributions are made, preferred stockholders must be paid before common stockholders. However, this claim is most important during time of insolvency, when common stockholders are the last in line of company's asset as usual. This is a huge disadvantage for the company's common stockholders. They are not easily accessible as the preferred stockholders. So this means the company must liquidate and pay all the creditors and bondholders. The common stockholders will not receive any money until the preferred shareholders are paid out. If they are not paid out, these fellows will not get even a single penny. So secondly, let's talk about the common stockholders. Dividend of preferred share stocks are different than the generally greater than those of common stock. When you buy a preferred stock, you will have an idea of when the expected dividend are paid at regular intervals. So as I said, if you buy preferred stock, you will have an idea or a clear concept when your money is going to be paid after a certain period of time each time. But in case of common stock, you do not have any kinds of certainty. In common stock, if the company is making profit, you will get profit at the end of year. If the company is not making, you do not have any kinds of assurance that you will be paid, or even at the end of the year. Even if the company made profit, sometimes you may not get your dividend, profit dividend, because of the common stock, because they are at the last of the pecking order. So adding this to the fixed income personality, the fact the dividends are typically guaranteed, meaning that if company does miss one, it will be required to pay before any further dividends are paid to either of those stocks. That means either of those means preferred or the common stock. So let's talk about share and bond. Firstly, what is share and what is bond? Share is the capital of the joint stock company that divided into some units of proportion. Each of their proportion is called a share. That means a company's small proportion is spread out into the market for the general people. Those are called shares. And what is debenture? The document which is used for taking loan from public by public limited company is called debenture. Debenture is those papers, documents. Documents are the lands documents, machineries documents, or the asset document that are submitted to a public limited company, and those limited companies funds the normal people. That is called a debenture. So let's differentiate between share and bond. Share and debenture. Debenture is also bond. So share is the proportion of capital or joint stock company, but debenture on the other hand is the document of loan taken by business. Price of sold share is the share capital of business. Price of sold share, that means the share that is sold in the general market, is the capital of the company that released the share. But in case of bond, price of the sold debenture is the loan of the business. That means they gave out money and they are willing to take that money back. That is the loan or the debenture. Shareholders are the proprietor of the business, but debenture holders are the creditors of the business. Shareholders are the proprietors. What does it mean? Shareholders are basically the owners of the company, and debenture, they are the holders and creditors of the business. Debenture holders are the creditors. That means they owe the company some money. They are not owners. They are liable to the company itself. So in share, equity shareholders have voting rights. Debenture holders have no voting rights. Why would they even have voting rights? They took loan from a company. They would not have any kinds of voting rights. Ultimately, in alternate cases, the company will just apply force on the bondholders or the debenture holders. But equity shareholders are the small owners of a company. They do have voting rights and do go to meeting with the other CEOs or the other owners of the company in their main head region. So, equity shareholders can participate in the management of the company as usual. Debentures cannot. Shareholders enjoy the profit of the business. In other hand, debenture holders will pay back the just loan simply to the business and nothing else. Shareholders enjoy profit from the business. Debentures cannot carry any loss and liability to the business. They must pay all the amount back to the company, else they will be issued. Shareholders can get the price of the share at running position of the business. What does that mean? They bought a share and they just simply cannot take the profit in the middle of the business while is it running. But debenture holders can get the price of debenture in the running position of business. They took the loan or the money from the business, and if the business is running within that time, they can just simply put the money back or give them the payback. That is very easy or very advantageous for the company and both the debenture holders. Let's talk about at the end of this chapter, let's talk about stock market or the capital market. In our country, we know there are only two stock markets, which is the Dhaka Stock Exchange and the Chittagong Stock Exchange. There are mainly two types, primary market and the secondary market. What's the primary market? Where the new issues are being sold to raise capital, and the second one is the market ongoing stocks are being sold. Primary market, new stocks are being made up, and secondary market, the stocks that are already in the market are being sold to the different kinds of institutions or people, whatever, the retail trader or the wholesale trader. Those are two different things. There are two basic types of exchanges, that is ordinary security exchange and over the counter. That means OTC market. So what's an organized security exchange? The organized security exchange is a formal organization having a tangible or a physical location of the facilities, trading, design, listed security. Two major exchanges are DSE and CSE in Bangladesh. That means Chittagong Stock Exchange and Dhaka Stock Exchange. So OTC market, over the counter market. The OTC market is a new network of dealers that provides trading securities not listed on the organized exchanges. These are like the third parties of the stock exchange market. So with that lesson, we finish the chapter 6 of long-term financing. If you have any kinds of question regarding this chapter, please let us know down in the comment box below. And if you like the video, please make sure to subscribe and share as much as you can. And thank you for being with Gurukul.